Just a quick introduction to what to expect this evening. So some very quick welcome remarks, and then we will have our panel discussion, which will be focusing on the recalibration of the global finance infrastructure, of course, in favor for Africa. For those of you who are here from Kenya, we know this has been a conversation that our president, our stakeholders in the finance system have been talking about for over the years. And the question we have now is, what does this mean for us as a private sector? What does this mean for us as Kenya? And we have an exemplary panel of discussants who will be taking us through what a global restructuring of the finance system works and how it would work for Kenya. So I'd like to now welcome our keynote speaker for tonight, also a friend of CNBC Africa, John Gashora, the CEO, Group CEO of NCBA Group. Let's give him a warm round of applause as he comes to join us tonight.
Africa, and yes, that includes our friends from South Africa, has converged in Nairobi for a pivotal conversation. Africa is at the center of that dialogue, and discussing the recalibration of the global financial system couldn't be more timely. When we mention finance and Africa together, words like aid, concession of finance, budgetary support, and others often come to mind. But let's challenge that narrative. In her book entitled Dead Aid, Why Aid is Not Working and How There is a Better Way for Africa, Zambian economist Nambiza Moyo argues for alternative models of development, such as debt relief, trade, and foreign investment, which have the potential to be more effective in promoting growth and reducing poverty. Today, we are going a bit further to question the architectural foundation of even those alternative models that she talks about. We are calling for a recalibration of global financing for Africa. We shall try to make a case for a better financing model for Africa. But we must ask ourselves, why does it matter? Why is this conversation even relevant? Is Africa even a worthwhile investment? Well, let me paint a picture for you. It's a continent with over 30% of the world's mineral reserves and 12% of its oil, with a population of 1.5 billion people, 20 of whom, according to Forbes Africa, are dollar billionaires. A continent with the youngest population is surely one that is consequential by every metric. But perhaps, for me, the biggest opportunity lies in this fact. A staggering 75% of these 1.5 billion people live below $2 a day. That's a monumental opportunity in itself. Allow me to share a couple of anecdotes. In the early 1900s, the Manchester Shoe Company, having faced stiff competition in England, sent two salesmen to find a new market for shoes in Africa. One salesman got on a boat and headed to West Africa, and the other one headed to East Africa. After 2 months of travel and research, the salesman who had gone to West Africa returned home and gave a very detailed presentation, obviously, to management, the kind of activities that he had seen Africans engaged in. And upon concluding his presentation, he said, "Gentlemen, as you can see, no one in Africa wears shoes. There's no market for us. Let's look elsewhere." The second salesman, who went to East Africa, did not return home. Instead, he sent a message. The message said, "Gentlemen, no one here wears any shoes. There's a huge market for us. Send inventory fast before competition finds out." We have all the ingredients necessary for investment, a large and growing population that is predominantly youthful, rapidly urbanizing economies, and strong natural resource endowments to serve the world's needs, particularly in energy transition.
The regulators and policymakers must, in Africa, speak louder. Okay, speak louder, but because we receive international, there are some rules, international rules that are set to fix some challenges that are not African challenges, but as they are set at international standard, African countries are obliged to follow. So we must speak louder, or I like your presentation, we must present our business cases to demonstrate that we have to think global, but we have to act local, even on policies and regulations. I believe, maybe I'm naive, I'm not a macroeconomist, but I believe that due to the potential of Africa, the population, the youth, the land, arable land, everything we have, I'm convinced that we have the possibility to change our narrative, to change our game, if we really want. And I also believe that if we use technology to improve the collection of our taxes internally, I think the President Ruto talked about that, in 20 years' time, we will be able to invest in debt, in private equity, in our economy, in local currency, and yeah. So just let's do it.
Ladies and gentlemen, welcome to a CNBC special where we'll be discussing the global financial architecture. My name is Abi Agina, one of the anchors at CNBC Africa. Remember, you can catch us on X at CNBC Africa, and don't forget to tweet as you continue to follow this conversation. Ladies and gentlemen, I'd like to bring to us this conversation with a first remark from the CEO of NCBA, Mr. John Gashora, who also serves as the chair of the Kenya Bankers Association. And my first question to you really is in regards to the opportunities that you see around this whole conversation around reimagining the global financial architecture. How can financial institutions latch onto this?
Thank you, Abby, and happy to be here. I think, as I said when I was speaking a bit earlier, the first thing that we have to appreciate is the problem. And I think one of the key problems is the cost of financing that Africa is having to bear, 8 times what the developed world or the G7s are paying for the same debt. As you'd imagine, the best credit rating of any enterprise in the country is the country itself. So when a country is paying 8 times the cost of debt, it means that the companies or the organizations within that country are paying above that. So the opportunity that we see in this change is that if our country ratings can be reviewed, if the borrowing costs can come down for our own countries, for the sovereigns, it means that businesses also will be able to get financing at a much lower cost. So that's the first big opportunity that I see. And certainly, those funds then can be used to help attack things like climate change, make sure that we're addressing gender imbalance, but more importantly, also support SMEs that happen to be the backbone of African development.
A great starter, Mr. Gashora, and I'd like to bring in Dr. Jose Akili. Looking at some of the key conversations that have been laid out tonight by Mr. Gashora as well as our team from Africa Guarantee Fund, it seems there is a role that the pension sector can play in all this. Where do you see the missing middle?
Yeah. Yes, I see the opportunity for our contract funds, which is the pension funds, playing a very big role in redesigning the financial market. There is a lot of outflow of pension funds to the developed country world, majorly through offshore investment by PE funds, and because we have a lot of trust in those destinations. I think the game plan is to understand that just like we had the two world wars, which were followed by a Marshall Plan for Europe, we are in a financial world war where the winner takes it all. The international financial institutions are, of course, calling the shots. We simply have to win this war as Africa if we have to recalibrate the financial dynamics. So my take is that we cannot win this war if we don't work as a team. Africa has to work as a team. We've got to think about having one single currency, and we've got to demand that those ones of our partners in developed countries who are taking our raw materials and using them to set up industries and do value addition in those countries have to come and set up those industries in Africa, or otherwise we leave our raw materials in Africa. Thank you.
Speaking about us as Africa being in a financial war, we've seen President Ruto indicating that he would love to see a more fairer system. And I bring this question to you, Munyi, in regards to the trends you are seeing, especially in the fintech space. We've already seen a huge bulge from African countries where there has been a sporadic growth in terms of fintech adoption. And as people continue to tap into the fintech space, what are some of the key conversations you are seeing that African countries need to step up?
Thank you, Abi. And I think some of the trends that we are seeing are underpinned by some of the things that, Gashora presented earlier. And so right now, the traditional fintech platforms were based on, what you're calling transactions and commissions, right? So looking at, the state of the African economies, things getting more pricier. And therefore, for example, if you look at, the finance bill, for example, if I can give an example in Kenya, and the proposals in the finance bill right now, there is already an increase, excise, in terms of excise, which is increasing the cost of transactions for banking fees. And John has spoken to this rather boldly, and he said, if this isn't reversed, we are looking at ourselves going back into mattress banking. So what it means then, it's continuing to be expensive for the individual to use digital platforms to transact. When you look on the other end, and this, we're speaking about the SMEs and MSMEs, the traditional commercial model for fintechs was getting a certain percentage of value moved. On the Visa and MasterCard model, this was anything between 1% and 3%. We are seeing that shrinking all the way to 0.25% on Lipa na M-Pesa. And looking at the macro environment, it means it is tougher to do business, and therefore any platform that is looking at getting more value from the merchant then loses in that transaction. So if this is what we are seeing in the market, then the question is, what's the way forward? What then we are seeing is what we are calling solution-based innovation. And solution-based innovation is around what problem are you solving for the business, for the individual. Because increasingly, the smaller businesses are not willing to part with that margin because the business environment means that their margins are already shrinking. So you come in and say, I want 0.5 or 1% of what you're transacting. They say no. But if you come in with a solution-based innovation, this then means that you're solving a problem that exists for them, that allows them to release a bit of resources that now you can see. And I'll give a good example. If you think of insurance, for example, there's a lot of fraud that happens on claims. So if a fintech builds a platform that says, hey, it's costing you X, and fraud is a number on your P&L. If it's costing you X, and building a platform that allows connectivity between the person who's insured, how money moves all the way into the insurer, and therefore there's connectivity and there's veracity of transactions. It therefore then means you're reducing your fraud cost, and therefore, if you say then I want to charge you 1% for this, it makes sense. So that is number two, solution-based innovation. What also we are seeing then is a lot of collaboration happening. And we're seeing what we'd call the legacy banking institutions partnering a lot, with fintechs to co-create products. And then finally, what we are also seeing is, platforms that are what you're calling API-led. Essentially, banks and legacy businesses investing in technology that is based on application interfaces, which means then they are open to integrate with non-financial institutions to be able to co-create new products.
Quite very deep issues that you've touched on, and it brings me to my next speaker, and this is a man who is not only redefining the petroleum business within East Africa, but across Africa, and this is Joe Sang. And the energy sector has remained as a key driver when you look at economic development for Kenya and the region at large. I'm keen to hear from you, what would be the potential impact that this could have, especially in the energy sector, when you're looking at reforming the global financial system?
Thank you, Abil. First and foremost, there's a direct correlation between the energy sector and the national economy, as well as the quality of life of the population. Today, most of the energy projects are extremely expensive. They're tanky projects. If you are laying, for instance, a pipeline from Mombasa to Nairobi, you need not less than $400 million for a 400-kilometer pipeline. If you are doing the geothermal, the same. And therefore, I see it in probably three buckets. The first one is about the funding. We must be able to unlock the funding architecture for the energy sector. The interest rates are really high, and we must work towards reduction of the interest rates that is being charged. The second one, which is big, is around the knowledge transfer and capacity building. There's also a need, especially from the global north, to learn from them, the developed world, that's the US, the Europe, and being able to share through various collaborations. And last but not least, around the governance structure in terms of how we manage those projects. So for me, those are the three buckets I'll be able to put in terms of how to unlock the potential within the energy sector.
Amazing. And I'll be coming back to you shortly because I'd like to quickly go to the newest CEO in town, Mr. Mwiti, CEO NSE. A round of applause for him. And great partner with CNBC. I'm also looking at the implications that we've seen across Africa when you're looking at the interest rates as well as the rising debt levels. When you look at the Africa Development Bank, they are quoting that Africa has a shortfall of funding of about $1.3 trillion annually. And from where you sit, how can this be bridged, especially when it comes to tackling matters financial stability and raising competitiveness?
Thank you. And as much as I'm a new CEO, I don't feel it. But thank you for the warm welcome. I wanted to just touch on three things in responding to you, Abby. And given that we're talking about a recalibration of the global financial systems, I think the first thing is to acknowledge that either way, it's a two-way street. There is responsibilities on our side as much as there's responsibilities on capital providers, whether here or indeed outside the continent. I think the first thing, therefore, is to say the equation here is risk versus reward. And as far as reward is concerned, I think there's no doubt there is return in Africa. I think no one would doubt that. So the question has to be, what is the risk side of things, and how can we actually influence that? And for me, I think the single biggest lever that Africa has to be focused on, and John touched on it, is around credit ratings. if we allow other people to tell us whether we are risky or not, it's unlikely that we would be able to move the needle or recalibrate anything for that matter. So I think we need to be present, 100% present, as far as how risk is underwritten and how we tell the story around risk in Africa. So that when other people are, whether it's rating us or indeed doing other risk-related decisions, they really do it right. And I actually do think fantastic platforms like CNBC and Forbes have a role to play to let the market out there know how risk really should be interpreted as far as Africa is concerned. So I think that's the first thing. I think the second thing is that we ourselves have to have the right policy environment to enable funds to flow where we want them to flow. We've heard about the huge gaps we have around infrastructure. Yeah. We've had the huge gaps we have around SMEs. We have huge gaps around climate-related challenges. What policy environment do we need that actually encourages or enhances flows of capital into those areas that actually solve our issue? And then to come to the more direct response to your question, which is, we have to deepen our own capital markets. Hosea talked about, for example, the role that our local pension funds ought to play in solving some of the challenges we have. I think it is difficult for a foreigner to fund something that local capital providers are refusing or are not interested in funding. I think it becomes very, very, very challenging. So at the NSC, one of the things we want to do is to be able to support the deepening of our capital markets, of course in collaboration with all the other stakeholders. I think the needle would move if we focus really on making sure that we ourselves are, putting our dollar where it ought to be, and then the rest are coming to just fill the pot. Lastly, I think it's important for regional cooperation. Some of the challenges that need to be solved really cannot be solved by whether it's a single country, whether it's a single institution, or indeed a single market player. So I think we need more intra-Africa cooperation, and that needs to be guided by the priorities that we are after. For NSC, I think the key point is we want to focus on making sure the local capital market develops. That way it's easier to crowd in other capital providers. Thank you.
All right, thank you for that, and quite interesting. And let me come in back to Gashora, who set the tone for this conversation. And Gashora, you have been in the banking business for quite a while, and you've seen the evolution from traditional banking to now digital banking, where we are seeing a future where you're going to be having cashless banking, which has already started to take root. But I'd like to hear from you, what are some of the barriers that African countries still face in attracting capital in the wake of all this global attention where Africa has been able to move from being on the menu to now being on the table?
I think there are two ways to look at that question. One is at the macro level, and of course at the micro level. So starting at perhaps the macro level is something that Mr. Mwiti just talked about, which is, and I sort of talked about it earlier, which is the credit rating of African countries. When your starting point is a B- rating, yeah, with a negative, what is it called, with a negative view, which is what they will say, you start really at the bottom. Yeah, and in international markets, that's not even junk. That's junk of a junk. That's what they call it, junk of a junk investment. So when it comes to when you start from that point, then when you come in as a company under that rating of a country, you are even rated lower. And I think our friend Frank, he knows these things very well about the guarantee funds and what they're supposed to do, try to raise up that rating. So that's the first challenge that we all face. So when it comes to raising funds, if you look at a bank like ours, we'll be raising funds at costs that are way higher than like, say, Standard Bank in South Africa or JP Morgan for that matter. Yeah. And we are competing to lend to the same customers. right? So that's problem number one. Problem number two is availability of data. Availability of data. If you look at Africa, one thing we have been so poor at doing is actually collecting data. And we talk about using data, but even collecting it. If you ask the question today, we all have anecdotal problems that we see. We'll talk about the fact that women don't have access to financing. But if you really dig into that data, and I think Frank talked about it, into that data, nobody has the very granular data that then informs you on what to do. Yeah. You look at countries like the US that have such granular data about everything. Yeah. I mean, they can predict through, sometimes they say what men underwear they are buying during that season, how the next, where the dollar is going to go. There are many things, they collect so much data. Here we do not, and I think that's the other problem that we all face. But the other challenge that we face is the gender balance problem. And the gender balance problem, we at NCB have looked at it quite closely. And we've wondered why we see more men get loans than women by far, by a mile, right? And what we have come to conclude is when you look at the most important thing for lending, which is character, women win hands down, right? They have much better character, and when you look at that, they win hands down. However, Africa, we are still caught up in this thing called collateral. And so when you look at collateral, most pieces of collateral in Africa are in the names of men, right? Families will go by land, and who appears on the title is a man, the man or the son. Right? Or the son, for that matter. And the wife doesn't appear, the mother does not appear. And so when they come to borrow, who do we then feel very comfortable to lend? It is the man. So that is the other issue that I think there should be working with governments, and I like the fact that here in Kenya, our laws are pushing in that direction where they are saying you cannot borrow as a man unless your wife comes along with you to sign what is called spousal consent, that you can indeed pledge that property that you have. But we need to go further to say, if that woman can pledge that property, then her name needs to also be on the title. So I think it's a myriad of problems that we all need to address together.
And Gashora, just to still stay with you on this point, how is this on the macro picture affecting our competitiveness? What is at stake?
At the macro level. So at the macro level, we have certain challenges, some of which I talked about. How I talked about Kenya and Nigeria and a few other countries where we are spending 40 to 50% of our revenue towards servicing debt. What that means, if you look at Kenya, for example, let me talk a little bit about Kenya because my friend Munyi talked about the tax issue. If you look at Kenya today, we are all up in arms because new taxes have been proposed. But let me tell you the situation that the government faces today. Our revenue collection is about 2.3 trillion shillings as a country, okay? Our debt servicing cost for this financial year that's coming up, it's 1.3 trillion shillings, okay? So that leaves you with 1 trillion shillings available from revenue collection. If you look at our salaries for government employees in this country, and other what we call recurrent expenditure, is exactly 1 trillion shillings. So you are left with nothing to send to the counties. Our constitution requires we send between 300 and 400 billion shillings to the counties. It's not available. It must come from somewhere else. There's development. We talked about the need. We have roads that we have to build. We have water that we have to give to people. There's housing that we're trying to do. There's no money for that. Yeah. So when you sit there and you think about the macro problem, then how does it then become micro? It becomes micro because then the government turns to all of us and says, you got to pay more taxes. Mm-hmm. And we end up paying more and more taxes, right? And the economists in the room know there is always an economist who will come up with numbers to justify why should be taxed more, isn't it? And one day I hope our economists just look at that and really come up with the analysis because I talked about the fact that revenue to GDP in Africa is one of the lowest in the world. That's true. In Kenya, the president has told us we're about 14%. He wants to move us to 22%. But you know something, my friends? If you look at our GDP, we have rebased our GDP 3 times in the last 20 years. And the rebasing has been because of capital investment. Yeah? We build roads, isn't it? That becomes part of GDP. Okay? We have people who are not included at all in the tax, what we call tax collection. They are therefore estimated and accounted as part of GDP. We have foreign investments that don't get taxed, that account as part of what we capital conversion, so it becomes part of our GDP. So when somebody says we need to go from 14 to 22%, when the productive GDP is perhaps 50%, Houston, we have a problem.
All right. I saw the gentlemen here staring at you pensively. Some of them had some interesting glances, including Dr. Keeley. You seem to have some answers to this, because what sort of actions can pension players like yourselves play, especially in the tapping into the opportunities that portend within the financial architecture overhaul?
Yeah, I'm a proponent of mandatory compulsory pension for savings by all citizens, because there's no other way you can raise adequate capital and support the same Kenyans or the same people who expect their government to come to their assistance at the old age. Now, to be able to raise the funds, you've got to, instead of taxing the people more, raise the funds from mandatory savings, invest it over the lifetime of those citizens, and use it to recalibrate the financial sector. When we have adequate funds of our own, we actually can now talk seriously. Aggregating the capital makes you a serious person on the table. At the moment, we want more and more from our government, but the only way a government can have funds is by taxing us. And then our government then becomes bigger and bigger in size, and we demand development. When we, the private sector, can actually negotiate with the government to be the real engine of development, so long as it can be legally and legally calibrated to allow the private capital to be used for investment in development of the country, and leave the little resources coming from our taxes to actually be used to run our countries. At the moment, our governments the demands by our politicians is asking for roads, and they want the government to do it. So the government, under so much pressure of our promising during elections, then they have to turn east or west or north or south to get the borrowed funds or to come and develop our roads.
Okay.
And that becomes a vicious circle. So the only way is let's raise our own capital. And the only way is, even in employment, we save because the employer has organized a pension. So that's the reality. There's nothing going to be done unless we accept that let's have a pension system which really has enough money. I look at South Africa, they have a leading country which has saved a lot of money for pension, and therefore they're able even to invest in all of Africa, while here in Kenya, the whole of East Africa, we are not doing anything serious. So that's my take. Thank you.
Amazing. Both Mr. Gashora and Dr. Keeley, you raise very weighty issues that I'd like to pick the thoughts of Mr. Munyi, especially in terms of how can fintech players tap into the financial inclusivity agenda that we see there is a gap right now. And this cuts across even in the energy sector.
Thank you, Abi. And I will digress a bit because I like the points that have been raised here, and I agree with Gashora. I mean, we are where we are. We have to raise the taxes to pay for debt. So it's a catch-22 situation. So in this case, yes, we have to increase our taxes. On the other side, you've got all of us who've got a payslip who are saying, hey, can you broaden the tax base so that we can also breathe, we can share this burden? And then on this other side, you've got a nascent industry that is a fintech industry that is saying, hey, could you please just leave us alone for a bit to allow us at least to grow so that we can contribute, bigger into the national cake? So it's really a very tight space to operate in. But then the question begs is, where are we losing value? Where can we generate value? And it goes back to what Gashora talked about. We don't collect data. And even when we collect it, how do we use it? How do we interpret it? What insights do we get from it? And I will give an example. So today, if you look at the agri sector, which is one of the largest contributors to our GDP, only 4 to 6% of the value that goes to the agri sector actually goes through digital channels. Yeah. And when you go down there, because I run an agri-tech platform, when you speak to the farmers there, you start understanding where we're actually losing value in some of these value chains. Farmers are getting less pay for what they produce because not all their produce gets to the processors. They're forced to sell on the streets at half the pay. So the question is then, how do you then bring in technology to solve some of these challenges? That's a Greek. Let's go to healthcare. I talked about the issue around insurance fraud. But think about it. If we had democratization of health data, for example, so that all this information is available, can somebody build an algorithm that actually gives you lower premiums so that we can increase the penetration of insurance from 2.5 to 5% to 10%, right? So these are the things that we are seeing opportunities that tech can come in and resolve. If I look at education, for example, I was speaking to some guys who run an education platform, and they were saying every year Kenyan parents default 9 billion shillings worth of school fees. It means that if you're an entrepreneur running a school, you're actually carrying the burden of the Kenyan parent. But the question is, do we understand how these parents and how they spend? Are their credit profiles up to date? So that you understand how can we chip in as a financial services sector to support that gap so that our children get educated. So we can go on and on about this, but I want to speak to my brother here on the side. And if you look at fintechs, and when you listen to a fintech has raised $10 million, $20 million, $100 million, and you applaud. But that money is coming from the West. So what happens? If I build my fintech and I have to repatriate these dollars, I'm transacting in Kenya shillings. I don't need to explain what happens there. I lose 20 to 30% of the value that I generate here so that I can pay my investors. So the question is to the fund managers, how about you start investing in technology businesses in Kenya so that as we generate value, we can give it back value to your shareholders and we can retain the value here in our continent. Thank you.
Thank you for that. And before we come to you, yeah, that one deserves a round of applause. Before we come to you, Mr. Sang, I saw Dr. Kili eagerly itching in his chair to respond to his comment. Just make it quickly, briefly.
Yeah, I think we owe it to ourselves to actually invest. And I think as a leader in our sector, we're actually investing now in technology. We would like to really have this conversation. We are all appreciative that we need to use our own resources to make this leap. So maybe the only thing we can ask our colleagues in the fintech industry is put a good governance framework and come up with the correct instruments for capital markets investment for our funds, because at the end of the day we also have to be sure that the money will come back. So if you do that, and our friend at the stock exchange is waiting for you to take some of these products into the market, I want to assure you that we shall take it up. I mean, I have proven myself that we can do this. Currently, I'm an investor in a new product for Islamic finance, a Sukuk bond, which nobody thought it could be done, but it's there now. So you do yours, and I'll do my part.
All right. Amazing. I see Mr. Karina quite interested in that, probably a potential investment opportunity here. Fantastic. And coming to you, Mr. Sang, you are literally at a crossroad when you're looking at the green transition. Africa is looking towards a just energy transition. And I'd like to hear your thoughts, especially around on the big opportunities in the energy sector that you see, and what are the challenges in achieving this?
Okay, yeah, so the big opportunities within the energy space is really around the green financing. Someone talked about Africa contribute a merely 4%. I think the statistics I saw was about 3 to 4% of the global emissions. Yet we get very, very small amount in terms of climate financing. So there's a huge opportunity in there in terms of how to tap. And even as we transition from the fossil fuel into cleaner or renewables.
Yeah.
And just some small statistics about Kenya, for instance. In geothermal today, we are actually number 6 in the world. I'm seeing most of you look shocked in the room. We are number 6 in the world. In terms of the hydro, we are contributing 46% international grid. So the total percentage of renewables is actually between 92% to 97% on a good weekend. When we talk about the wind, the solar. So there's a lot of scope in terms of partnering, especially with the private sector. As I said before, it's capital intensive sector, and there's a lot of probably syndication to be done among the lenders for them to come together and finance a project. That is one. I've talked about the private sector partnership. There's a public-private sector partnership. Someone talked about the pension fund. And again, the statistics I saw the other day is, and to Dr. Kili's point, we're actually talking about over $1 trillion shillings in terms of savings. So there's scope in terms of how do we leverage on our pension funds in this country. And last but not least, we need to create opportunities in terms of the tax incentives for this sector. That would be a big one for us.
Indeed. Speaking about tax, I'd like to also still stay with you, Mr. Sang, especially when you look at how can Africa and Kenya maximize on the potential in the global financial restructuring from an energy sector perspective?
The big one is really collaboration. We need to collaborate as African nations, and we can come in form of, we now have the Africa Union, which is very vibrant. There's Africa Free Trade. So if we come together, I think we'll be putting a position, and I like what the president said the other day in Kigali, that we are no longer going to be sitting as a bystanders, but we are going to be at a table or in the menu. And that responsibility starts with each and every one of you in this room. We should be able to put a position that is favorable to our organizations as well as our country. The other one I talked about earlier was about knowledge transfer as well as collaboration through sharing ideas. Most of the developed world today have been on this over the years. It's about time we reach out to them through our School of Excellence to be able to get and learn from them so that we quicken the learning curve. So those are some of but the big one, as I said, is coming together as African nations to be able to put our stake on the table.
Thank you for your sentiments, Mr. Sang. And still talking on matters climate, I'd like the NSC to weigh in on this, because how can capital markets enable investments, especially in the green energy space, and what opportunities are there right now that we can leverage on the continent and also as a region?
Thanks. Let me share something that we noted 4 weeks ago. 4 weeks ago, we went to the UK for a roadshow to meet large fund managers. So, you know, the names that you know, BlackRock, Amundi, Mobius, Ashmore, these large fund managers. And on our way there, we were talking with my chairman, And the apprehension we had was that we will have to convince these guys that, Kenya is attractive. What we came back with was a different problem. We don't have a demand issue. There is actually funds looking to get deployed in our market. And Kenya in particular is actually very, very attractive. What we have is a supply issue. And the reason I say that is because they, for example, said, we are very interested in investing in sustainability-linked instruments. We want to get exposure to ESG-related projects. But either they are not there, or the ones that are there, the size is too small, or they're not structured right. So, to respond to your point, Abby, for NSC, part of what we want to do is really work with the ecosystem to actually be able to originate, to support the origination of projects that are aligned with what investors want, and we know sustainability is one of them. And in that sense, obviously, we'll be going for the typical instruments that you already know, so green bonds, as an example, sustainability-linked issues. Would be very happy, for example, to discuss gender bonds. And of course, there's also conversations around carbon credits and what that means from a financing perspective. I think the point I'm trying to make is, if anything, actually, Kenya, and I would say even Africa, stands at a fantastic space as far as sustainability-linked financing, let's call it climate finance, is concerned. What we need to do is do the heavy lifting to actually originate the right projects. And that's not easy. So one of the things, for example, in discussions with the FDB is how to help us come up with a capacity development facility to actually work with, whether it's fund managers, whether it's project sponsors, to actually be able to increase the capacity to actually originate and structure properly put together ESG projects, because then the flow of capital will come. And the last thing I think to say is, if you see some of the reporting requirements that are coming through, whether that's in the financial services space, pure banking from their primary regulator, or in fact from the NSC, because we have our own listing requirements, increasingly being aligned with ESG and the reporting and disclosure requirements that are required for that will be mandatory. I think time has come for us to accept that this is not some nice to have kind of thing. But I think the key point for me is that NSC wants to work with the larger capital markets ecosystem to build capacity so that then we are able to tap this new category of funding that is actually readily looking for projects to fund. Thank you.
Thank you for those comments. And ladies and gentlemen, we are just about to draw to a close on this panel, and quite some heavy, enriching comments coming out. And I'd like us to now get to the point where we get the closing remarks. And I'd like to start off from the far end and allow NSC to take the first slot.
My closing comments will be three things. Number one, as far as recalibration is concerned, I would want us to put as much attention and focus around the credit rating agenda. I think we need to be able to move that bit. The second thing is local investors, local institutions, pension funds, insurance companies have to participate in funding our own development agenda. I think the foreign investors should come second. Local capital providers need to come first. And I think the third bit is this point about policy. We need to continue to improve the policy environment, especially policy interventions that enable capital to flow in the areas where we want. Women, SMEs, climate, infrastructure. Thank you.
Thank you for that. Let's get to hear from Mr. Sang.
The big one for me is, I can see most of the people in the room are private sector. There is a lot of scope and opportunity to work with, to partner with government in terms of the public-private sector participation. That's especially in the energy sector. There's a lot that is happening. We are soon as Kenya Pipeline moving into LBG, which is the cleaner fuel in terms of transition energy. And we'll be looking for partners in the private sector space to participate. And finally, I think it's the saying goes that change begins with you and I. We can change this country for the better. Thank you.
Excellent. Winnie.
Thanks, Abi. Three quick things. Number one, we've talked about, the demographic advantage that Africa has. The question is, from a data perspective, what are we doing to ensure that we're able to capture that data that allows us to include even the bottom of the pyramid into the financial systems? And here it speaks to digital public infrastructure. Mostly when you talk about DPI, we talk about connectivity. But the question is, how can we use that infrastructure to make sure that these people are digitally included? And this is a way that now we're able to get that data. Number two, the biggest challenges we are facing at tech companies or fintech companies across Africa is in settlement, moving money from one country into another. So the settlement system, first of all, and then secondly, purely just moving currency out of Ghana, out of Nigeria, out of Mozambique, out of Angola is a headache. So how can we solve that problem so that even as we leverage on tech, we ensure that our legacy financial system supports what technology is trying to solve for? And finally, and this is to government, the question is, when I look at things like regulation, I put it in three very quick buckets. One is foundational, what we already have that is governing the banking system. The second one is catalytic, which is what now is pushing innovation for startups and all that. But I think what is lacking in our regulations, in our policy, is what we would think as aspirational regulation. A regulation that tells us this is where we want to be 20, 30 years from now. We're yet to see that. The only way we can do this is if we have participatory policy making that allows the people that are leading this conversation to be part of that process. Thank you.
Thank you. Dr. Kelly.
Yeah, mine, I would like to put a challenge to anybody in the audience or any of the people who like to receive our investment funds. For example, I started with my brother here, Joe. Joe, the other day, we are aware that the government of Kenya and Uganda signed, I think, a memorandum of understanding about two major projects. One is an extension of the oil pipeline from Eldoret all the way to Kampala. I know in the past you have been doing financing the pipeline using what you call a consortium of banks and so forth. I would like you to consider talking to us as pension funds. And you come up with an instrument, and I want to assure you, challenge, as we have come together under an association called APTAC, which brings all the trustees of the funds, and which I'm the president currently. We are ready to engage, and you don't have to go outside Kenya to get your money. So I would like to challenge you. And equally the same, we have other projects in the energy sector. There is a shortfall of transmission capacity for our country. Anybody who is wants to get involved in that area, kindly come to us. We're ready to partner to finance transmission across our country, because those are real impactful developments. And then, of course, we have the fintech or the IT sector, the networks across the country. That's an area, so long as it is packaged properly. So the challenge as which you have thrown to us, that are we ready to invest? We are ready. But, of course, we want to see properly packaged projects and which we can then invest in. Thank you.
Thank you, Dr. Kelly. And clearly, you echo the sentiments of CNBC, where we say fast in business. Mr. Gashora, you have the... I'm already prophesying. You have the final word. We've been saving the best for the last.
Thank you. So since 1945, the Bretton Woods have defined the financial architecture in which we operate in. And as Africa, we've looked at the Bretton Woods Institutes as a guard of finance. I think this is the first time we are questioning the architecture of this setup. My final word is we must keep questioning it. We must question the gods. We must push back. We must make them understand that what they have told us before, we do not trust. Which brings me to a very final story. A priest is going for a jog, and he unfortunately slips on a cliff. And he is falling, he finds a root, and he holds himself onto this root. And he is holding, and he looks up, and he's very far up. He clearly cannot get there. And he looks down, and he knows if he lets go, he's a dead man. So he talks to the person he's always prayed to. And he says, God, if you're there in heaven, please tell me what to do. And a voice comes down. If you trust me, let go. He thinks for a moment, and he says, thank you, Lord. Is there anyone else up there?
Wow, wonderful way to end. Thank you so much, Mr. Gashora, for that very hearty closing punchy point. Well, ladies and gentlemen, we can do better. Let's give them a better round of applause. We were delighted to have with us the CEO of NSC, Mr. Frank Mwiti. Thank you for making time for us. We were also honored to have with us Mr. Joe Sang, the Managing Director, Kenya Pipeline. Thank you, sir. And also in our midst, we had a very interesting young man who has shaped different conversations. He looks young, but I know he's of age. And this is none other than Munyi Nthiga, who is the General Secretary of the Association of Fintechs in Kenya. And we also had the honor and pleasure of having Dr. Hosea Kili, who wears many hats, including the Managing Director of CPF. Thank you, sir, for making time. And to our gracious host and our storyteller for the evening, this is Mr. John Gashora, shooting from the hip, does not mince his words. Thank you, sir, for making time for us. Well, and on behalf of the CNBC Africa family, it has been an awesome experience as well as a singular privilege to moderate this session. And right about now, that's where we want to leave it at on this panel. And we do hope you will be able to engage with us in our future subsequent discussions. My name is Abi Agina, and that's where we bring it to a close. Have a lovely evening.